All right, everybody, welcome back to the Rice Report. Great conversation ready to go today. Inflation numbers just came out at 2.8%, expected at 3%. We've got volatility in the market. We've got tariffs. We've got all kinds of new things being thrown at us. So today we're bringing on Mario Veneroso from Kingsview. He is one of the partners there, a wealth manager. And I'm just really excited today, Mario, to talk about what's going on in the markets and get your point of view from Wall Street. These guys manage a ton of money. So I just want to kick it off by saying thank you for being here today, Mario. I know I've got about a half an hour with you, and let's start talking choppy markets and volatility. What are your thoughts there?
Absolutely. Well, thanks for having me. Great to be here. And I think if we look at the last 2 months of what's going on in the markets, this is what I'm telling my clients, and this is what I would tell every single investor. Number one, focus on the trend line and not the headlines. So, me personally, seeing all this volatility into the markets, I actually think it's going to create an opportunity. And a lot of the markets, especially with this tariff talk, and I get it, right? You know, 1 minute we're going to have tariffs, the next minute we're not. Then there's a delay, and then there's an exemption. And then, earlier this morning, I saw a headline now that there's going to be a reprieve of 50%, the steel tariffs on Canada. So to me personally, anytime that the market is interpreting any type of uncertainty, the market doesn't like that. What is the market like? The market likes certainty and predictability. But what I'm telling all my clients and investors is very, very simple, Eric. It's this. Have a broader perspective. And I think if we listen to the tariff talk and we actually look at the underlinks, and as a mechanic will open up the hood of a car and see what's wrong with the engine, you'll see that there's nothing wrong with our economy and there's nothing wrong with trying to have fairer trade practices. At the end of the day, it's very, very simple. Our net imports from tariffs is $1 trillion. Our total economy is 36 trillion. So what does that equate to as far as a mathematical standpoint? A big nothing. It's 3%. So yes, could tariffs be inflationary? They absolutely could. However, I think tariffs are going to be more used as a tool with Bassett and Trump as far as having better trade practices with the U.S. And I said this last week on nationwide on TV, and I'll say it again today. Right now, the way this market is, we have to have some short-term pain for some long-term gain. And that's exactly what we're in. And I think that with these markets, with the volatility, and also it's always, and I've been trading these markets 17 years. I always tell clients this. It's an escalator on the way up, but an elevator on the way down. Markets don't go straight up forever. And then you have to have the clairvoyance, the wherewithal, and the courage to buy on the dips. Because if you like a company trading at 100 and the market retraces and that company now goes down to 80, you're getting it on sale. And you have to have a broader perspective and a longer term time horizon. And I think we'll be fine.
I agree with you there. I think the short-term pain for long-term gain. Our economy hasn't had to go through aerobics in 3 decades, right? We've had cheap money. Everything's been pretty simple. 0% interest rates for 15 years. We're going to the gym, right? That's what America is doing. We're going to the gym for the first time. So you're going to be sore, but you're going to end up being stronger in the end. Now, with the CPI numbers coming out at 2.8 and trueflation down to 1.8%, the price of eggs are dropping, lumber skyrocketing, which is kind of interesting. With the home builder sector. What are you seeing on you mentioned that the economy is good, the market's good. People will disagree with that statement. I actually do. I think the economy has been very weak for 3 years, but the market has been very strong, which is pretty normal cyclically. But I think right now we're getting to a point where tariffs and reduction of taxes will strengthen the economy.
Absolutely.
When those two things come together, you said short-term pain, long-term gain, and a lot of economists, myself included, predict that we'll see a 6 to 8 month choppy volatile cycle, potentially a recessionary trend, and then maybe the biggest bull run in history. What are you seeing here in the next 18 months?
I think that's a great question, and I agree with that sentiment. I think the next few months, and also too, you have to take the seasonality of earnings season, right? Earnings season is coming down to an end. And guess what? In real estate, they say location, location, location. In the stock market, it's all about earnings. And we're having double-digit earnings growth. That is good for all the Fortune 500 companies. That is good for America. That is good for economy. But I do believe we're going to have some volatility, and for a few reasons. with anything in life, when you embrace change, there's an X factor, an uncomfortability factor. You can see what Trump's done in 45 days in office. He signed more executive orders than you can possibly argue what the previous administration did in 4 years, right? So it's a more aggressive approach. And with this type of approach, that's why we're seeing the volatility. But I think we have some major, major catalysts. And as a money manager, as a man who studies the markets, recognizes patterns, tries to find arbitrage and the best type of risk adjusted returns for my clients, I think there's a lot to be excited about. And I'll give you some specifics. Number one, all right, we talked about tariffs, how they're inflationary, but there's other policies that are going to trump any type of inflation with tariffs. And overall, we're going to be entering a deflationary period. If Trump does lower taxes, and also he lowered taxes in Trump 1.0 the first time around, right? From 16 to 2020, tariffs went from corporate taxes went from 28% down to the low 20s. If he lowers them again, that's going to be a major boom for the economy and the stock market. So lower taxes on the corporate side. The second thing is lower income taxes, personal taxes. We're talking about no tax on tips. We're also talking about no tax on Social Security, which I always thought was a fickle road because you pay in your whole life to Social Security and then you get taxed when you take it out. It's like a double whammy.
It's a crime.
So I think with lowering taxes, that will be a huge proponent that will make the economy, the American consumer, and the stock market go higher. The next thing, though, if you look at what's on the agenda, speaking not the next 6 weeks, but the next 6 months and 18 months subsequently, I think if we also look at deregulation, and I think this is of vital importance, I can't begin to tell you just within my industry, and I have a lot of clients, they're in manufacturing, they're in this industry, technology, various industries. There's so much red tape. I bought an investment property a year ago. The amount of red tape that you have to do now for a mortgage is like it's the equivalent of 4 Bibles. It's just astronomical. So I think we need some deregulation. And I think that will to make not only companies more efficient, but to make the economy more efficient. And then the last thing, and I think this is the biggest proponent. So stocks and bonds have an inverse relationship, right? Stocks go higher when bond yields go lower. Look what just happened to the 10-year Treasury. And maybe we're getting into the weeds right now, Eric.
No, this is perfect.
And getting very technical. The 10-year Treasury just went from 4.8 down to 4.2. That is a huge move. So let me tell you what that means from a practical matter when it comes to the world of investing. You get guys like me who don't manage 7 figures, 8 figures. I manage over $300 million, right? So when you're moving hundreds of millions, billions of dollars, I look on my screen and I say, you know what? A year ago, I could buy a treasury bond for a client earning 5.5% and no state income tax. I'm in New York. Taxes are astronomical here. Well, that same bond, if I were to buy it today, maturing within a year, that same bond goes for 4%. That's a 25% return. So then it's not worth it at that point. Then it says, okay, in order to hit my bogey on pension plans and retirement plans of 6, 7, 8%, I have to be more geared towards equities. And that's going to be a major catalyst. So right now, the 10-year Treasury, as we speak, is retracing. Like you said, the CPI numbers came out. They came out lighter than expected. We're now in 2.8%. PCEs in the mid-twos. Like we're going to that 2% regime. And I think that's going to be more of a green light for the Fed to cut. I personally believe with all the statistics we have right now, that I'm of the belief we're going to cut 2 to 3 times this year. If you look at the Fed futures market right now, they're predicting about 3 rate cuts. The first one in June, and that's about an 85% probability as a first thing this morning. So if they cut rates, and then we have the lower taxes, lower income taxes, less regulation. Oh, and by the way, Eric, we're getting a little tax break right now. Crude oil just went from $80 a barrel down to 65. All that is going to help the American consumer. They're not going to feel, the tie's not going to be so tight around their neck, and they're going to have a few extra dollars in their pocket. And I think all that will be bullish for the stock market and the economy.
Mario, you're hitting the nail on the head because we have a little over $9.2 trillion in 2 to 2.25% bonds that need to be refinanced, those 10 years. And for the listeners
Yep.
out there, that 10 year is pegged to your mortgage. So root for that 10 year to continually go down if you're looking to buy a new home. FHA, first time home buyers, 14.8% default rate. 14.8% is the highest default rate for new home buyers ever. That's due to that very high 10-year yield. So what are your thoughts about that? Besant was given a hand grenade without a pin. When what Yellen added $6 trillion to the debt to the deficit, roughly. All those short-term T-bills that she
Yep.
processed in her last 6 months, you're looking at like a $800 billion added to the overall national debt in the last quarter of her existence. Thank God she's gone. I don't know how she ever got that job for a second time. But I call her Satan's accountant, to be honest with you. She's terrible. So we have this ticking time bomb, this hand grenade with no pin. Bissett walks into the office. He basically has 15% less liquidity than any other treasurer that's ever stepped into office. $9 trillion in 2% bonds. I cover this quite a bit. They just refied $66 billion in these 2% bonds up to 4.5%. That adds $1.6 billion a month to the deficit. These are tremendously large numbers. Do you think that the stock market kind of dump, right? I call it a washing. Like, stocks and bonds are kind of like two guys scooping water out of the same boat into the other boat. So,
Mhm.
when water comes out of the stock market, it goes into the bond market. You drop the bond price, you drop the bond yields because prices go up. Do you think we'll be able to achieve this at like 3.25, 3.5? I mean, 4.5%? We're adding something like $2 trillion to the debt. Do you think that has something to do with the equation as to why Trump's even stated, I'm not even watching the stock market right now?
I think that is a vital point, Eric. So many Americans and investors, they pick up the papers and they read, but there's only so much that a piece of paper or a white letter can give you. The practicality is this: we have to lower rates because, well, as you said, Satan's accountant, our balance sheet is going the other way, not going in our favor. So that's a very good point. Let's take a look what happened last week at the ECB. The ECB just cut. For a decade, you had the German Bund actually having a negative yield. Now it's positive. But the rest of the world is still in a very low interest rate environment. We can't have rates high like a skyscraper when the rest of the world's rates are low. That obviously creates an imbalance. And if you factor that in with our fiscal imbalance and how much debt we have, like you said, 9 trillion is going to be maturing now. I think they're going to cut, 2 to 3 times. So right now the Fed funds rate's around 4.25. If they cut 3 times, that puts us anywhere between 3.25 and 3.5.
Yep.
And at that point, it's much more manageable. But nobody's talking about that because nobody wants to, wipe yolk from their face and mud from their jeans and say, hey, you know what? Satan's accountant, ballooned this balance sheet much higher. We have to do something about it. But this is what must be spoken in order to fix it. You have to recognize the problem in order to solve the problem. And I think that's a vital importance because I know behind closed doors in my heart of hearts, I believe that is on Jerome Powell's mind. I believe that's on the rest of the Fed governor's mind. And look, at the end of the day, how good is our money if we're not going to be A plus rated at all, right? So that's a vital point, and they're going to be forced to lower just to help balancing their budget between that and other efforts that this administration's doing.
Yeah, no, we have quite a few high net worth individuals that watch the show, and we cover this quite a bit. And you specialize in that high net worth environment, and you're the professional. I own a PE group that does high compute and Bitcoin mining, all those things. But I was a money manager, and I tell people it's not financial advice, but I'm like, the VIX is a good place to look in the next 6 to 8 months. Volatility is the only certainty in the market. You kind of agree with that stance? I think the trading, don't ever own the VIX, by the way.
Yeah, no,
Never
no,
own
don't
it.
own the
Trade
VIX.
it.
But I think as a money manager, I use the VIX as a barometer when we have capitulation, right? So the VIX, if you look at it, spiked astronomically the last few weeks, and that highlights capitulation moments when there's overselling. But at the end of the day, and I always say this, The stock market, the way it works, it's a voting machine in the short term, right? You turn on the news, oh, I hate Trump, I hate tariffs, I hate that, this and that. I get all that. But at the end of the day, when the rest of these policies start to come in fruition, it's for the betterment of America. Who wouldn't want lower taxes, lower interest rates? You spoke about first-time home buyers. They have double-digit default rates right now because not only is the housing market still at all-time highs, rates are still high. You put both of those in the equation, it's a recipe for failure. So I think there's a lot of underlings within the economy. But I always say this when it comes to that we're going to improve on. But I always say this with the market sentiment and how the market moves. It's in the short term, it's a voting machine. But in the long term, it's a weighted machine. So this is what I'm having conversations with and telling my clients. And you may have more of a stomach being in Bitcoin and mining and everything, because with a drop of a dime, Bitcoin can go from 80,000 to 70 and then back up to 100 and back down to 70. But I tell clients this is I always construct a portfolio, not with 2 asset classes, with 4. So I actually have things within my proprietary portfolios that are working regardless of what the market is doing. So if you have 4 asset classes, you'll have stocks, you'll have bonds. I have a real asset sleeve, which is gold, oil, and real estate. All 3 of those are doing better than the stock market this year.
Yep.
And then I have an alternative sleeve. So you want to construct a portfolio where you're going to be comfortable taking these bruises to the downside, but you're going to bend but not break. So if you're 100% in technology stocks that are double levered or triple levered at this point, and you have a risk appetite of a municipal bond investor, obviously you're not in the right portfolio. But to me personally, on these dips, I think it's an opportunity. I think our trend line is still intact. I think luck kisses the brave, as I always say, Eric. And the best way to solve a problem is prevent one. So have a portfolio that will have less drawdowns, defense mechanisms in place. And I have things within my portfolio that are doing well this year and is creating a ballast. So you made the great analogy. It's like 2 guys on a boat when you have stock and bonds, right? One's doing the water and the other one is too. Well, I have 4 guys in the boat, and they're having a water vacuum at this point. Not even just a cup. So I'm always having ingredients within the portfolio that should work when one area zigs and another zags. But I think you got to take a broader term perspective. I think people do need to breathe. I know the market's done a lot of damage in a short amount of time, and the market feels differently. But this is normal. Markets have corrections every 12 to 18 months. So, recently coming into today, the NASDAQ was down 10%, almost 10% for the year and about just under 15% from its high. The S&P numbers were down about 5.25% for the year and just under 10% from its high. Like, that is an opportunity. So at the end of the day, you got to block out the noise from the actual sound. And to me, the sound of the future is going to be a sweet sound. I think there's a lot of bullish catalysts. I agree with your sentiment where the market will set up second half of the year to be bullish. I think there's a few things that need to happen. Number one, some of this trade noise does need to die down a little bit, and it will. Right? This is all brand new. You look at the last administration. Let me ask you a question, Eric. How many times did you hear anything with Biden as far as negotiating tariffs on the news the last 4 years?
Well, he never left his basement. So
yeah, that's exactly my point. So now we have a president that's ambitious, that does want to, create a more prosperous America, and an America where, your first-time home buyer, you have a 1 in 7 chance of defaulting. That's not the America that this country was built on. So to me, again, it goes back to short-term pain for long-term gain. But I do believe as these policies start to come to fruition, and after the tariffs, then we're going to start tackling taxes, extending tax cuts, having more deflation. And then the biggest catalyst will be lowering of the rates, because I agree with you 100%. Our fiscal debt is high. We have to lower it. And we'll also have to lower it because guess what? When you lower rates, you stimulate the economy. We were speaking about mortgages. Mortgages at 7.5%, 8%, when you're already tight on the dime, they look a lot better when they're 5.5% and 6%. And that will stimulate the economy.
And it doesn't move volume. I think I saw a stat the other day where something like 59% of America has below 5% mortgage rates. That's never happened.
Yeah.
So you have to lower those mortgage rates to stimulate the real estate economy, because right now first time home buyers who are buying homes are failing, and the rest of them are just sitting in rentals until times are better. So I think
Absolutely.
we'll see this pump fake, right? Like I used to love basketball till it went woke. But the pump fake, right? Like I
I
think we're
always
gonna
say
have.
if that's woke, you know what? I'll stay asleep.
Yeah, yeah, agreed. But I think we'll have this pump fake environment where I think we're going to have something scary that looks like a recession will be called a recession in the first couple quarters of the year. But then I think you're going to see a drastic turnaround. Everything that you've talked about, Mario, super bullish news, but it has to come with some short-term pain, as everyone's arguing or discussing. But I think the opportunity, like I've been in the markets for 20 years, so have you. Have you ever seen such a predictable path to the future? Like, this government actually has been incredible at expressing two things. When Trump came into office the first time, he said we need a weaker dollar to stimulate global economies.
Yep.
Genius. This time he came in, said the same thing, and we need lower rates. So of course, the first interaction, Jerome Powell says, "I don't listen to the president. I'm never going to lower rates." Despite the fact that at the election he raised rates or lowered rates so that Biden could get an extra few fake votes from dead
Yeah,
voters.
well, he
Um,
said that, and the same thing happened in 2018. If you remember the
yep.
Q4 of 2018, the market retraced 20%, and then Jerome Powell, you can't rely on Powell. It's the Powell
Mm.
pivot. It's the
Yeah.
toothless tiger. He says one thing and does another. So I agree with you 100% with that.
I think it's what an exciting time to be in the markets, to be an investor, be working with groups like yours. I would have these conversations with your financial advisors. You know, this is in my opinion, and we could be way off here, Mario. Like so, no, full disclosure, we are not Nostradamus. We do not see the future. But as market readers, I think it's pretty obvious to see you're going to see a flood from equities to bonds for a period of time, a bullish market being set up over the next 6 to 8 months. And then you're going to see that flood out of bonds back into equities. And I think you're going to see new asset classes emerge in the next couple of years. You're already seeing it with Bitcoin and
Yep.
some of these stable coins, some of these other assets they're talking about. That education is very important. I'll be doing some segments on this show to marking that up for you in your brain so you can figure out what it is. But Mario, as we get set to wrap up here, what advice would you give the average investor? I know you work with really high net worth and clients and things like that. So of course you have that special sauce. I don't want to ruin that here in a podcast, but for the average Joe with a 401k and an IRA, and what advice would you give him over the next year and a half?
Absolutely. I think valuations matter in the stock market. We were high coming into the year. Now we're at a more reasonable level. Earnings are strong. And I think if you take a broader term perspective, the next 12, 24, 36 months, if we have lower taxes, that's going to help the stock market. If we have lower rates, that's going to help the stock market. If we have less regulation, that's going to help the stock market. So any one of those will be a bullish catalyst. If 2 out of 3 happen, I think we'll be happy. And if 3 out of 3 happen, I think we'll have a very nice setup. And they always say this, and I'll end with this note. You know, the best indicator of future success is your past success. What have you done in the past, right? If you look at Trump 1.0 from 16 to 20, it was a very good time in the market. Of course, there was choppiness, but that's how markets are. They go up and down. But I always say this: the advance is permanent, the decline is temporary. Set yourself up with quality investments, buy on the dips. And I think in a year, 3 years, 5 years, you'll be very happy with this pullback.
I think that's great advice. That's great advice. And one thing to touch on here that you just kind of beat into my head. So, as a former oil and gas executive, the regulations in oil and gas are going to create. People keep looking at the price of oil dropping, which is a great thing for the economy. But the drop of regulation means one thing for the oil and gas industry it hasn't seen in 25 years. You can have lower prices and higher profit margins.
Yep,
So I'm very
absolutely.
bullish on that sector in the next 5 years. I think oil and gas is going to be great. Mario Veneroso, Kingsview Wealth. This has been an absolute pleasure. I look forward. Maybe we can have you back on in a couple months and do a market update. We'd love to have you back.
Absolutely. I look forward to it. And I think all the content was valuable content. Appreciate the time today. And hopefully we turn on a few light bulbs with some of your listeners and they avoid the noise and block out the sound.
Absolutely. Absolutely. Mario, thank you so much for being here. We wish you all the best and we look forward to having you back on.
Thank you. Pleasure.